Time now for today's strategy session. Our next guest says to buy any market weakness as the Santa Claus rally will continue into the new year, taking the S&P 500 to 6150 as stocks melt higher. Joining us now is James Demmert, who is the Main Street Research Chief Investment Officer. Okay, so as you're looking for those dip buying opportunities here in a melt up, I mean, it sounds like that includes everything on the table, NVIDIA even, which is in a bit of a correction as of right now.
Yeah, I think it does. A lot of investors got out of the market before the election. Mm-hmm. And another example, don't do that, right? Don't trade on politics. And there's a tremendous amount of FOMO that came with that, and all of a sudden now you're seeing that race to the end of the year. A lot of people also who are institutional investors want to go to their clients and say, hey, we were fully invested, so you want to make that look good by the end of the year. So that's why I think you're getting this push, and it could easily take us to 6150. There's not a lot of time left, but we think we can get there.
So what happens once we do get there in the new year? Are we going to then see a pullback? And I guess how big of a pullback are you expecting?
Yeah, I think that's a really good point. Investors should recognize that 25 is going to be really different than 24. Mm-hmm. First of all, this rally, which has been really dramatic since July, is starting to look a little bit vulnerable. I think Josh mentioned it in the previous, you get more narrow breadth, some technical stuff, right? So going into 2025, I think investors should start to prepare themselves emotionally for, let's say, a normal correction of 8 to 12% in markets. We really haven't seen much of that. So you can prepare yourself emotionally. You can also prepare your portfolio by maybe pairing some of these giant gains that we've seen in the last couple of years. Question is, what would tip off, that sort of pullback in this environment where everyone's so euphoric?
Yeah.
And our view is, the technical sort of set up to a little bit of vulnerability, a little bit too much confidence, I think, is what you're seeing amongst investors. But I think the key point in 2025 is investors realizing the Fed really is already probably at the neutral rate. They're probably not going to have to cut very much at all in 2025 because you've got them, they kind of got the economy where they want it, 2.8, inflation sort of subdued, maybe even too sticky. I think the message in the first quarter is they're not doing anything. The market have a nice big correction. Investors should buy that correction because we're in a bull market, the early phases.
Do you expect the Fed to come out today, even if they do cut today, and then look out into the future and say, okay, we could be at a good place to pause for an extended period of time? And what would the market reception be to that?
Well, you might get that correction sooner if they really emphasize that. And I think that as much as they should be neutral related to the politics around them, they're very aware that the Trump administration is going to bring some things that are inflationary, right? Deportation being one, high growth rates. That does let the economy sort of grow, inflation sort of come up. I think they're going to want to send a message that they're going to be much more careful going forward, but how they send that message could move markets.
James, what does that then mean for market leadership? Because we've seen this rotation kind of back to some of the Mag 7 names, because very much viewed as the fact that they did work when the Fed was raising rates. They did work when we were at higher interest rate levels. Is that a trade that's going to work then next year if we're not going to get those cuts that maybe the market is anticipating?
I love that question. It's been such a Mag 7 market. And in 2025, we think those stocks do well, but other stuff just as well or better. Because of the valuations, and also let's think about the second derivative of AI, which is away from the Mag 7, the companies that are using AI, invested in AI, that now the earnings will be accretive. And you can see that in technology and software. You can certainly see that in other industries, such as industrials and healthcare.
When we think about the other secondary plays around AI as well, it's been clear for chips because it seems like there's going to be enough of a consistent stream of purchases, a new baseline that gets set in for the companies that are really powering the data centers and making sure that there is enough of the inferencing technology taking place. What is the secondary play that already has some elements of monetization that investors can look to have a steady stream of revenue source?
Yeah, and I think that's a safer trade,
yeah.
Right? I mean, we're big fans of NVIDIA. We own shares there. But here you want to sort of go off into the areas where their valuations might be better and the upside surprises might be better as well. Broadcom is a great example of that, more of a tailored chip maker if you want to look at chips alone. But if you look at a company like Palantir, obviously in the news because of great performance, really what that earnings driven is coming from is that AI investment. And you saw that earlier with Meta in this year.